Hey, Kerry with Best of US. What is the repo market and how is it going to affect me? And why hasn't my financial advisor talked to me about that? This is what I want to address today. First, let me explain these. I had eye surgery last Friday, and I think there's something of an extraction, so that's what I'm going to do. I'm a retired financial advisor. I was in the business for many years, and I got to admit, honestly, I didn't have a real understanding of the repo market. My son, who bought my financial planning practice from me, was at the house this past weekend relative to this surgery, and he started talking to me about the repro market and how it might be a signal that there's something wrong with our economy, and it might be the signal that pretty much alerts us to when the market is going to collapse. He said, what's going on hasn't happened since 2008, when the last financial crisis occurred. And that got my ears perking. So he went on to explain this to me, that the federal government had to come in and create liquidity back in last September, and then has been doing it basically since October to keep the wheels greased, if you will, so that our financial markets continue to work. That scared the living bejesus out of me. So I said to myself, I need to learn more about this. It's very complicated. So I'm going to rely on some other videos that I've been able to draw from YouTube that I want to share with you that made it clearer to me as to what this was all about. Because if I haven't told you, I went to cash. Let's see, this is probably about last October. And I've been there, and I've now moved into a bit of a treasury position, because my belief is if this market collapses, it's going to be because of a lack of liquidity, and the dollar is going to lose value, the market will lose value, and there will be a rush to secure investments, and the most secure investment is the U.S. Treasury. So that's what I've done. But I feel it's important that I share with you, and I'm not going to try to get those words to come out of my mouth. I'm going to share some other videos that I've seen, and I'll give credit where credit is due, because that is the right way to do it. So here's some information on what is the repo market and how is it going to affect me.
Take a look at this chart. It tracks how much banks and others pay for overnight loans using something called repurchase agreements. This is also known as the repo rate. These bumps right here on September 16th and 17th have caused a really big stir in the financial world. That's because the repo market is a critical part of the financial system. It provides a lot of the grease that keeps the wheels spinning, meaning it provides the cash that financial firms need to run their daily operations. When the repo market chokes and cash stops flowing, trouble can reverberate through the economy. That's what happened in September. And in response, the Federal Reserve had to step in to help, providing tens of billions of dollars to borrowers to keep the system cranking. In the weeks since this happened, experts have called the incident a technical malfunction. And banks, for their part, have said it could have been prevented. They're blaming the rules that were put in place after the financial crisis. Rules intended to keep the banking system from falling apart. Imagine two people, Karen and Mark. Karen has $1,000 and she'd like to earn some fast interest on her money. Mark has a stack of treasury notes, but no cash. So he strikes a deal with Karen. One note for $100. But there's a catch. Mark has to agree to buy that note back tomorrow for $101. The difference between the price of the note on day one and day two, that's the repo rate. If everything works properly, Mark gets the cash he needs right when he needs it. And Karen makes some fast money. The repo market functions in the same way. You just have to replace the Karens with money market funds and other asset managers who are looking to make a little money without a lot of risk. and replace the marks with hedge funds, Wall Street traders, and banks who have a lot of assets but need cash on hand to fund their day-to-day trading. In the repo market, Karens and marks all over the financial system lend back and forth for short periods, often overnight. And they do this at an enormous scale. Usually more than $1 trillion runs through it every day. On September 16th and 17th, when the rate spiked, the Karens were not willing to trade cash for securities at the usual rate. So the marks, who needed cash, kept offering more and more and more, until the Fed arrived with help. When the Fed announced its surprise repo operations, people wanted to know, why did the Karens suddenly stop lending? Experts point to two financial deadlines that sapped cash out of the system on the same night, causing a crunch. September 16th was the cutoff for banks to submit their quarterly tax payments. So a lot of money that they might usually lend in the repo market was being sucked out of their accounts and deposited into the Treasury. September 16th was also the day that $78 billion of Treasury debt was scheduled to settle, which just means that another chunk of cash was being turned into securities on that day too. Now, some banks said the crunch was compounded by another factor, a rule put in place after the financial crisis to keep banks solvent. The rule, which is called Liquidity Coverage Ratio, or LCR, requires banks to keep a certain amount of reserves, or cash, on hold at the Fed at all times, among other things. The idea was to improve the banking sector's ability to absorb shocks arising from financial and economic stress. You can see it on this chart. Since the crisis, banks have stockpiled cash in their reserve accounts. Their argument is that keeping these funds on hold makes it harder for them to lend out cash on a dime when money gets tight. Now, for the Fed's part, Chairman Jerome Powell dismissed the possibility of revisiting those rules.
If we concluded that we needed to raise the level of required reserves for banks to meet the LCR, we'd probably raise the level of reserves rather than lower the LCR.
What he's saying is that the Fed would rather provide the extra funds itself than lower those liquidity requirements for banks. And since that press conference, the Fed's done just that. In October, it announced it would start buying short-term Treasury debt at $60 billion a month and continue through at least June of 2020, which means there's going to be money to borrow even if the Karens stop lending again. Its aim is to boost reserves, allowing banks to stay liquid without violating the rule. And in doing so, to keep the wheels of the financial system spinning.
Okay, I think that's a good explanation. What concerns me is that, as I said, I'm a retired financial advisor. I didn't know anything about this. So I want to ask you a few questions. And I want you to answer them in the comments. And the first question is, did you have an understanding of the repo market? And answer in the comments, yes or no, then comma. Second question, do you have a financial advisor? Yes or no, and then a comma. If yes, has your financial advisor given you any information about this in the last several months relative to what happened in September, what they thought was going to happen in December, and what may happen again in March, June, next September? And if they haven't shared that with you, elaborate to me how you feel about that. Now, again, my son, Trent Grinkmeyer, brought this to my attention. And I said, is this something you're discussing with your clients? And he said, well, of course I am. And that's why we have the portfolios that we have. We've been making money off of treasuries, and we've been making money off of gold. And what I want to know is, has your financial advisor, have you had any knowledge of this? Because again, it so looks to me like what happened with the dot-com bubble. Nobody was telling me, and I was a financial advisor, none of my advisors within the corporation that I worked for was telling me this market's getting out of control. And things are happening that shouldn't be happening. Secretaries are becoming millionaires with stock options, and things are happening that shouldn't be happening. And then in 2008, nobody was coming to me and saying, this market is all out of whack, and people are buying real estate who can't afford real estate, and lenders are lending money to people who can't make the payments back, all in anticipation that the homes that they're buying with a bubble interest program in the future are going to appreciate in value, and they can unload them to repay the loans. Nobody was talking to me about that. Yet if you watch the movie The Big Short, that information was out there, but our financial advisors were oblivious to it. And so I guess when I see things that shouldn't be happening, the bells start ringing in my head and saying, I got to figure this out. What's happening in the repo market and how is it going to affect me? So please, for number one, if you like this video, like it. Number two, give me your feedback. Put some messages in the comments, like I asked, the yeses, the nos, is your financial advisor, and let's see if we can't together figure this out before it just slaps us in the face again, because I don't want that. So I had promised you in my last video about the future of AI in this 2020 that I would do a piece on the repo market. So there you have it. Like it, thumbs it up, and leave a comment.